In this presentation, we will record the journal entry related to the retirement of bonds. For more accounting information and accounting courses, visit our website at accountinginstruction.info. When we talk about the retirement of bonds, we could just mean that the bond became due. It's the maturity date of the bond, and therefore we're going to pay it back just like any other kind of loan, any other kind of liability that became due, and therefore retire the bond. However, it could mean that we have a callable bond and we're retiring the bond at some date before the maturity date. So first we'll take a look at this in terms of it's a maturity date bond and we're just going to pay off the bond at the end of the time period. So, and note that this type of transaction isn't one we often see in test questions because they're usually the more interesting stuff happens at the beginning of the bond. What's going to be the cost of the bond? What's the discount? How are you going to amortize the discount on the bonds? What do the interest payments look like? The end of the bond is actually pretty straightforward because all we're going to do is pay off the bond amount. In terms of journal entry perspective, we're just paying off the bond amount that looks pretty much just like a loan. So let's see what we're talking about here. We have the information on the left side. We're going to record the journal entry here in our general journal and then post it to our worksheet, the worksheet being in order with the assets, liability, equity, revenue, and expenses, debits positive, credits bracketed or negative, debits minus the credits being 0, meaning debits equal the credits. Net income is currently the 700,000 minus the 17 or the 682,832. So this is just to give us something in balance so that we can see when we post these what's going to be what happens generally to different types of accounts, the accounting equation, and the individual accounts and net income. So we have 15-year bonds, face amount 240. The issue price was 198,484. The interest and the market rates here, and what we're saying now is we're going to retire the bond. Now, if we look at the trial balance, what does that mean? It means that the bond is on the books for $240,000 and there is no discount or premium. Why? Because we're saying it's at the end. It's 15 years later now, and we've already paid all the interest and we've amortized the discount down to 0. So in order to see that, if we look at our amortization table, the discount started at 41,516, which is 240,000 minus the cash that was received of 198,484, and then we lowered that discount every 6 months, and we recorded a journal entry lowering it by the 1,384. So the discount went away each time, and it was going to the interest expense. So at the end of this whole time period, at the end of 15 years or 30 time periods at every 6 months, we are left with 0 in terms of the discount, and we have the 240 then is all that's left. So now, if we look at the end, we can see that the 240 bond payable looks just like a loan, basically. So we're paying back the loan at the end of the time period. There's no more interest. We're saying here that the interest payment has already been made. So all interest has been made, all of the amortization of the bond has been made. So we're just going to record the final entry to close out or eliminate the bond. So to do that, we're just going to say the bond payable has a credit balance. We're going to do the opposite thing to it and debit it. So I'm just going to copy, put the debit on top. We probably should have thought of cash first. Is cash affected? Yeah, we're paying back the bonds. So cash is going to go down. So I'm going to copy cash, put that on the bottom because it's going to be decreasing, and the amount's just going to be for 240,000. So we'll debit 240 and credit 240. That's all there is to it. Now, note that if you see this, some problems may combine the two. They may say, well, the final interest payment, the final amortization, and the retirement of the bond is happening. And in that case, you would just record the final amortization journal entry, which would bring the discount fully down to 0, and then the interest, and then record the reduction of the bond, paying off the bond. But the actual paying of the bond, if it's fully amortized, if it's the end of the time period, is similar to just paying off a note. If we were to record this, then we're going to go to the bond payable. We're going to record this here in H6 by saying equals and pointing to that 240, bring the 240 down by 240 to 0, putting us out of balance. And then cash is going to be posted. Here's cash on our journal entry. Here it is on our worksheet in H3, where we say equals, point it to the 240, bringing our cash down to 664, and that puts us back in balance. No effect on net income here. We're not dealing with any interest expense. We're just paying back the principal. Now we're paying back the principal. And note here what happened with this bond is we didn't pay any of the principal through the entire bond time period, through that 15 years. What we did pay was interest. We paid the rent on the money. We didn't pay back the principal on the money. Now we're paying back the original principal. Now the other way this could happen, if we could retire the bond early if it's a callable bond, and so we could retire it before the maturity date. And if that's the case, then a book problem will typically give you what we're going to retire it for. In other words, it'll have to give us the amount that we're going to pay in order to retire the bond at this point in time. And once we have that, all we got to do is eliminate the bond from the books, and any difference will be a gain or a loss. So in other words, if we have a trial balance, it'll show us this information. If we're talking about a book problem, it'll have to give us what we're going to retire it for, the cash we're going to pay, and then the bond, amount, as well as any discount or premium. Ours are going to be given here with the trial balance. So in other words, we can go through our questions. Is cash affected? Yeah, we're going to retire the bond by paying it off early. So we're going to pay the $230,000. So I'm going to copy cash. And I'm going to put that on the bottom. So I'm going to skip 4 lines and put it on B23, just because I happen to know there's going to be 4 accounts. Right click and paste 1, 2, 3. And again, if you're building this yourself from scratch, you might put the cash on top and credit it. Even though it looks funny, it might be easier to build the journal entry. And it's better to look funny and get it right than build it in some way where you can't get the answer. So then we know that cash is going to be for whatever they gave us, which is the 230, credit 230, and there we have it. So then we got to take the bond off the books. So we're going to retire the bond and the related discount. So whatever the bond is and the related discount, they need to go away. So we know that the bond is on the books for 240. So that's a credit. So we're going to do the opposite thing to it, a debit. So I'm going to right click and copy it. And I'm going to put that on B21. And again, I'm kind of just making this work in terms of debits on top. If you're making this from scratch, just do it whatever way makes sense to build it top to bottom. Not worrying about debits or credits going on top. Right click and paste 1, 2, 3. It's on the books for 240. It's a liability with a credit balance. So we got to do the opposite, 240 debit. And then the related discount or premium, this happens to be a discount, needs to go away. The only problem there in practice is that you may not have a trial balance and may not know whether or not the discount or premium is a debit or credit account, and therefore, what do I do to it to make it go away? Do I debit or credit it? If you have a trial balance, to give you an example, you can see, oh, it's a debit balance if it's a discount, so I have to credit it. If you're looking at a multiple choice question, then you're just going to have to know, and a couple things you might think about. You might say, well, I know bonds payable is a credit balance account, and a discount should make it go down because that means that we issued it for something less. So the discount must be opposite to the normal balance because these are two related, and it's got to bring it down. So it's got to be a debit. On the other hand, if it were a premium, the payable is a liability representing kind of the sticker price. And if we sold it for more than the sticker price, the premium must make it go up. So it must be the same thing as a liability. It must be another credit if it were a premium. Here we have a discount. It's a debit balance. We need to make it go down, so we're going to do the opposite, which is a credit. So I'm going to copy the discount. I'm going to put that here in B22, right click and paste 1, 2, 3. And then the amount's going to be a credit, 38,748. And now, of course, the debits don't equal the credits. These add up to 268,748. This adds up to 240. There's going to be a difference, if we highlight all of it, of 28,748. That's going to be the plug. I'll do that with our plug formula, negative sum. And then you could sum up from the bottom like this, or you can move this out of the way and sum from top to bottom. And there's our 28,748. If I highlight the whole thing, we're back in balance. And so now I'm going to unpost this for now. Now we just need to know what that is. And that, of course, is going to be a gain or loss on the retirement. So when we retire it, we're going to have a gain or loss. What's the gain or loss going to be? Well, it's going to be the carrying value, the 240 minus the discount or plus the premium, 201 to 52 minus whatever we have to pay for it. So in this case, 230,000. And of course, if we're paying, in this case, we're paying more than the carrying amount, this is going to be a loss. And you can also think about it's going to be a loss because it's a debit and it's going to be on the income statement. And debits are what expenses do. So that means it's a loss. If it were a credit, that means that we would have been paying less than the carrying amount and have a credit, which would be a gain on the income statement, which is kind of like what income does on the income statement. So I'm going to copy this gain or loss. I'm going to copy that, put that over here, right click and paste 1, 2, 3, and there we have it. Now let's post this out. Here's the gain or loss. Here it is on our worksheet. We're going to be in the middle column, age 30 equals this 28,748. That's going to bring this up, put us out of balance, and bring net income down. So that's all. You know it's a loss when we record it because net income goes down. And then here's the bonds payable. Here it is on our worksheet. We're in the middle column, age 23 equals the 240, bringing the bonds payable to 0. Here's the discount. Here it is on our worksheet. We're in the middle column, age 24 equals the 38,748, bringing it to 0. And then we've got the cash going to age 20 equals the 230, bringing the cash to 0 and putting us back in balance. For more accounting information and accounting courses, visit our website at accountinginstruction.info.